I think we see your introductory screen there. Is that where you want to start, Mark?
Yeah, yeah.
All right. So great. Thank you again for being here, and appreciate your patience with our technical difficulties. But go ahead and get started as soon as you're ready.
Okay, thank you. And listen, I appreciate everyone who's taking their time out this afternoon to come and to listen to my presentation. I just want to give a little preamble on the slides I'm going to show, because what I'm going to show you is a very low risk, high reward trade configuration that can be taken with futures, forex, or stocks. The bottom line is this, and the reason I titled the presentation "The Failure of Indicator Analysis to Predict Future Price Movement" is that 95% of all day traders fail. And if you take day trading as an endeavor, that percentage does not increase over time. Now, that's really a conundrum if you think about it, because of each generation of day trader who failed, then went to the next generation of day trader who profited from the mistakes of the prior generation, then what we would get is an evolutionary process whereby each generation of day trader slowly developed a basic trading methodology that led to a successful strategy. Now, we as commercial traders are fighting the institutional guys, and in that arena, we cannot win. What we want to do is we want to trade with the institutional guys. So when we start, my background, and part of my postgraduate training involved the optimization of multivariable equations. So what we did at RightLine was decide that as a closed system, the prediction of future price movement can be done with a series of multivariable equations that, when optimized, would provide you with a very, very precise direction for market, i.e. a trading entry that had a high degree of specificity, a low degree of sensitivity, a high degree of prevalence, and therefore an excellent positive predictive value. Now, I didn't go into these numbers on the slides, but I want you to understand that accepting the things that you have been taught without asking for mathematical proof is what leads to trading failure. Now, if you think that an oscillator that uses data on your trading chart is going to predict future price movement, you're walking down that path of 95% failure rate. If you think even that a MACD is going to predict future price movement, when assimilating data from your trading chart, you're also walking down that same path. Now, we also accept, and I could have this all laid out for you in slides, but I think that everybody here gets the idea. There are people who are Fibonacci fanatics, but has Fibonacci. Now, Fibonacci was an obscure 17th century mathematician who obviously developed Fibonacci transformations without any consideration for the stock market, and it's an interesting mathematical derivative, but it describes very, very little in nature. And when we used forward, we went back 2 years of recorded data and then moved forward to look at the precision of Fibonacci. whether or not a specific Fibonacci level would hold or break, i.e. would it increase the precision of your trading? And it does nothing at all, as does the oscillator and as does the MACD. So part of walking the path to success is discarding all of the previous information that you have been told, because it will lead you down the same path that all the previous generation of day traders has walked. And it doesn't matter whether you're day trading the futures market, the Forex market, or the stock market. If you use these indicators to help you fine-tune your trades, i.e. increase precision, which is the same as saying the positive predictive value, or what percentage of your trading entries are going to move to your first target and lock in profit, you're going to be mistaken. So we took a different approach at RightLine. And I'm going to show you a little bit of that approach and show you how we arrived at such a unique trading configuration that, again, can be applied to futures, Forex, and options. Now, we have an options trading newsletter, which I'm going to talk about later, which has been remarkably successful based on this trade configuration. We trade vertical spreads, almost always bull put or bull call, and we take some call trades and some put trades. We have in the portfolio now. We have 11, or I think we have 15 open positions. All of them look. All of the spreads look like they're gonna finish with 100% of our net. Of our net equity on the bull puts. The bull calls are all profitable, and I recommended a couple of positions last night that I'm going to show you. But I want to show you the trade configuration. Now, it's called the transition zone trade, and it's the most profitable trade configuration that we ever have developed. Over 85% of the entries are going to go on to be winners. Now, what is a winner? A winner is when the trade goes to your first target as defined by your trading strategy and locks in enough profit so that if the trade comes back on you, it's guaranteed to provide you with some money. So 85% of these trades are going to make you money. And I'm going to show you these entries. The risk to reward is superlative. In the way that we've configured the trade, your maximum average loss is $150. And you can win as much as $600 to $700 on a single trade or on 2 contracts if you're trading futures, 2 lots if you're trading Forex, and a very small number of contracts if you're trading options, if you're day trading options. And it leverages the direction of institutional money. And like I said, 2 contracts can easily make you $500 plus. Now, what we define as an independent variable is an indicator that predicts price movement, but doesn't use any information from your trading chart, which is the key. If the indicator requires price on your trading chart to fall to signal a short, it has no value. If it requires price on your trading chart to move up to signal a long, it also has no value. And let me tell you right now, we have looked and looked and looked at trading tops, bottoms, reversals. Sometimes they're very profitable entries, double tops, double bottoms off of market profile, value area highs and value area lows, but they're inconsistent. The only way to trade is with the trend. Now, let me just give you one more theoretical, one more theoretical proposition. And, it's a little off the beaten path, but I want to get you to see what the market is and to change your way of thinking. If we look at the laws of thermodynamics, every closed system will always tend to move to a state of maximum randomness. Now, if you have a kid at home and you look at his bedroom, it always goes after you make his bed or her bed, put all the clothes in the closet, and vacuum the carpet. You come back 3 days later and the room's a wreck. That is a closed system. And in a way, it's not really a joke. The fact is that without the application of energy into the system, which in this case is you're walking into the room and either yelling at your kid to pick up his stuff or applying energy and cleaning it up, it's going to just get messier and messier. Well, the same is true of the stock market. Any closed system without the application of energy in the stock market, the futures market, the Forex market, the application of energy is money, and it's institutional money. That is what creates order from chaos. When there is no institutional money being applied to the market moves in a chaotic fashion, as does every closed system that is present in the known universe. That is a law of physics, and the market obeys these laws. So what we look for is a multi-time frame alignment. Now, the multi-time frames that we look at are our two higher time frames. Now, here we have crude on a 5 range. Now, when we trade a range chart, we look at our two higher Fibonacci numbers, which in this case work quite well, although Fibonacci does not predict market direction. We look at the 8 range and the 13 range. If we trade an 8, this indicator automatically defaults to a 13 and a 21 range. If you trade time, a 3-minute, it's going to fall to a 9-minute and a 27-minute. If you trade ticks, doesn't matter. It's going to assess the direction of movement of your two higher time frames. And it doesn't make any difference what price is doing on your trading chart. Now, in order for your two higher time frames, now this pink is the strongest down color we have and the only one that's important on this trade, pink and dark green. We want both our higher time frames to align to the downside, and we want all support to the downside to be broken. So the indicator looks at support and resistance as well as the trend. It's a smart indicator, and it has a little bit of algorithmic analysis. So it just doesn't signal when you've got your 50 and your 15, which is your 50 simple moving average and our 15 proprietary moving average heading to the downside on your 8 and your 13. It also makes an assessment that all support to the downside is broken. And you can see that the only kind of trade you want to take with this pink is a short trade. If you take a long trade, the positive predictive value of the trade is going to be exceedingly low. And most of the trades are going to lead to a loss. Now, so this is one of the indicators that has to be in our favor to take a transition zone trade. We need multi-time frame alignment of our two higher time frames. Remember, in order for that kind of order to appear in a system like this, which is desperately trying to move in a chaotic fashion, it requires the application of a significant amount of money for a protracted period of time. Only the institutions can create this. And this alignment in a trending market is a powerful signal that we want to take the market short. But it's not enough. It gives us a bias, but it doesn't give us a trading entry. And that's what we need. Now let's look at another independent variable. Now remember, nothing is looking at price on our trading chart, and it doesn't matter again. I can't stress this enough, whether these are futures, Forex, or stocks. If you want to ride a stock on a day trade move, you wait for multi-time frame alignment, you wait for support to be broken, you wait for this color, and you can ride this trade. Now, the trade configuration, like I said, calls for a very small risk and the potential. You can see the move here. I didn't trace it out or scale it, but this is a huge move to the downside, and we can capture all of it. Now, here is the other indicator that's critical, and this is, we call it our quant analysis indicator. Now, what this indicator does is we know, again, that certain markets, when bonds move up, certain markets move up in concert with bonds. One of those markets is notes. Also, there are other correlative markets that move in the direction of bonds when bonds move up. The other parameter is that certain markets move down when bonds move up. And really, if we look at any financial instrument, what's going on in the course of a day is really, for all intents and purposes, even though there's money inflow and there's money outflow to mutual funds, and the best way for us to look at it is that there is a fixed amount of money to be traded by the institutional guys every day. And what they do is sector rotation. When risk is on, they're going to move to the higher risk instruments, like stocks, like futures. When risk is off, they're going to move to the safer investments of bonds, notes, precious metals. Rarely do these instruments move up in tandem. So what we did was we created a quant analysis indicator. And that's because there are 3 markets in each line. Now there are 6 correlative markets that we found that correlate with bonds with a correlation coefficient of 0.7 or greater, which means that when bonds go up, these markets also go up or go down at 70% of the time. So it isn't a perfect indicator, but you've got 6 markets total in each line. So what it's telling you here is that money is flowing into bonds and all of its correlative markets that should rise when bonds rise, and flowing out of the financial instruments that should fall when bonds go up. It's the best indicator I know. I mean, a lot of people claim that they can follow the institutional money, but nothing follows institutional money better than this indicator, because it's showing you 6 markets without having to look at them. And it's almost an impossibility to do when you're trading, is to have 6 charts, all with the correlative markets, and determine the trend. Well, this indicator does it for us. And you can see that bonds rises, that the quant lines are green, not because bonds rise. Bonds rise because the quant lines are green. The quant lines are telling you that money is flowing strongly into bonds. And the positive predictive value of a long trade here is exceedingly high. Now, when you combine the 2 indicators, you're starting to see what we're looking for in a transition zone trade. We're looking for multi-time frame alignment. We're looking for money to be flowing into the financial instrument we want to rise, whether it be stocks, bonds, or stocks, bonds, futures, or Forex. And this gives us a direction based on other parameters other than price on our trading chart. You'll notice there's no oscillator, there's no MACD, there's no Fibonacci. They play no role. I am telling you, because we've analyzed these indicators on 2 years of market replay data. I mean, everybody trades an oscillator differently. Some people in an overbought market will continue to buy, will say, the bulls are in control. I'm going to buy every pivot as it breaks to the upside. Other people will trade the oscillator looking for oscillator divergence and look to fade the market. We all know how often divergence is run over. And I can tell you, continuing to buy a pivot to the upside as the upside pivots are broken is a zero-sum game. It's the same thing with the MACD. You can buy a crossover on a momentum move to the upside. The problem is it going to continue? And you can't tell. That's the problem. Now, the other thing that we look at is the direction of the 50 and the 15. I mentioned it before, but we want the 50 simple SMA. This is just a simple moving average. And we want our proprietary 15 to be moving to the downside. When we have this, we know that the application of institutional money is present. There's a defined downtrend in our, say this is our higher time frame, and this is our second higher time frame. And this is when we're going to take a look for a short entry on our trade. Now here's one that we're not taking. This is a consolidation entry, and I'll just mention it briefly. I don't want to take up time on this, in this webinar for things that really aren't that relevant. But I just want to show you how important it is to read price action market structure with indicator analysis, with the quants, and with background bias. Now, the longer consolidation occurs, every down candle is trapping a majority of sellers. Every up candle is trapping a majority of buyers. Sellers trapped, buyers trapped, sellers trapped. And the longer the period of consolidation, the more contracts are trapped in that zone. Now, unless the trade is oversold, excuse me, consolidation almost always, breaks out in the direction of the trend, because that's the institutional money being applied. And every market, even with the application of institutional money, can go into a period of consolidation. Now, I'll just tell you, consolidation is the options killer of options trades. Because if you take a momentum play to the upside, you have no guarantee that the market isn't going to consolidate. Now, if you're looking to take a short trade on an options play, on a momentum trade to the downside, the consolidation can last for days. In fact, consolidation can last for weeks. So that is a tremendous options killer. And you have to be really careful not to trade and then get a period of consolidation. You're going to stall out, and time is going to erode the value of your put if you happen to even be in the right direction. A retracement is also always possible. This is why it is so difficult to trade options. And 7 out of 10 options traders do not make money, because a trending stock can go into consolidation or retracement, never break its trend. I mean, you've called the direction of the trend correctly, but market timing is everything. And the software has to tell you when to take a trade out of consolidation or take a trade out of a retracement back into the trend. That is what the software does and what it leverages. And the nice thing about a period of consolidation is the longer it takes place, the more likely it's going to explode in the direction of your trade. What you want to take is an entry right before it explodes, not 3 weeks before it explodes. Depending on your time frame for taking an options position, a stock position, a futures position, or a forex position. You want to take the entry right before consolidation breaks. The software I'm going to show you will give you a great consolidation entry, and you are off to the downside. Now remember, there's no time frame on these candles. These could be daily candles, weekly candles. They could be 4-hour candles, and I purposely left it open like this because it's relevant on every time frame. Doesn't make any difference. It's time frame independent. You get into a short trade on stocks or options or futures and forex and walk into consolidation. Now remember, you don't have a financial instrument that decreases in value unless you're trading options. You can hang in there with stocks. You can hang in there with futures. You can hang in there with forex. But if you trade options, your option is going to diminish in price, and eventually, you're going to have trouble making your money back. Now, let me talk a little bit about the entry criteria for a transition zone. Now, we always trade a retracement and then a continuation. Why? So that we don't walk into a retracement or walk into consolidation. We want the retracement to already have occurred, and what we're doing is we're taking a continuation. The same is true at a consolidation. I could have put this as early retracement consolidation after transition zone. I'll show you the trades. The background goes to pink, 2 higher time frames to the downside, all support broken, or green, 2 higher time frames to the upside, all resistance broken. You enter on the first retracement after the entry. You're trading futures. The first target is 7 ticks. Your stop stays at -10. Hit your first target, your risk for $30. Right here, you're up 70. You still have 10 ticks of risk on the trade. Once the price hit 10 ticks, the stop moves to -5. Your maximum downside cost here is plus $20. Once it goes to 10 ticks, you're then up. You can make yourself you can take yourself out to McDonald's. Now, if you're trading stocks, you can convert this to shares. We have an ATM for stocks. And that's the way you're going to trade an option out of a transition zone entry. Now, the exit criteria for a transition zone is fixed. If you're trading futures or forex or stocks, you know exactly when to exit. If you're trading an option, you know exactly when to close the option. It's a 15-tick trailing stop is hit. Upside or downside resistance or support is hit. And our proprietary 15 turns yellow, telling us that the trend is over. When the trend ends, you want to take your money and walk away. It still can reverse back to the downside, but it's unlikely. This is where you're going to put your money in the bank. Let me see where I am here. Now I'm going to show you a trade. Now I hate when people do this in webinars. They show you, they cherry pick a trade, and they can show you a series of 500 winners in a row and skip all the losers. And that's not what we want to do. We want to show you, and we're going to move to the charts very shortly, and show you all the transition zone trades going back 20 days on crude. And like I said, it doesn't matter the financial instrument, and it doesn't matter the time frame. I didn't configure it for stocks, but I could have easily done that. And you can see here, here's the transition zone, the change to green. The strongest entry is when the retracement occurs on the zone color change. What that is telling you, and I can't draw on this, but this is really broad-based consolidation. Sideways, 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 with the market making slightly higher lows and slightly higher highs. But you don't really have to care about that. I mean, I think that reading price action like this is important. But the key here is the indicator. The quant line is green. On crude, we only have 3 correlative markets, not 6. On the E-mini, on other futures we trade, we have 9 correlative markets. It's got to be in your favor as well. Money flow has to be into crude. You take the first retracement, and you're in right here at the blue line. Now, you have a 15-tick stop, and we analyzed 2 years of data and found an enormous number of trades that come back 14, but not 15. You would get this trade all the way to the upside. That's 61 ticks. It's also on a stock, it's 61 cents, depending upon what instrument you're trading and your time frame. Now, you're going to take your 15-tick hit here because there's nothing that signals you're still in an uptrend. But if you subtract 15 from 61, you're going to get 54, I think. Nope, you're going to get 44. 46. I can't add. You're going to get 46 ticks plus your 7. That is a $530 trade on 2 contracts on crude. And that's your whole day right there. That you're able to ride this trade all the way to the top. And remember also, you can take this out on a discretionary basis at any time. I mean, when the trade's up 50 ticks, it's got to go to 65 for you to make more money. If you closed it at 50, you'd make $570, which is just a little bit more than you would have made if you closed it at 61. But the bottom line is, if you just let the trade ride, these are the kind of trades you're going to see over and over again. And the key is, when the trade fails, it almost always goes 7 ticks in your direction to give you a maximum loss of only $30. And if it goes 10, you make a profit of $20. And then, so your losses are tiny and your potential upside enormous. That's what you want, that risk to reward. The only limitation is that we're only on NinjaTrader. So that's where you're going to have to take this signal from. But you can trade it on any platform. Soon we're going to be on Sierra charts. But if you trade stocks and you use like TradeStation, that's our next stop. But you're going to get the signal and you can take the entry. If you trade options, it's just going to tell you where to enter an option. You're not going to enter an option in consolidation. And you're not going to enter options where you're still going to get a retracement. And it's going to be a multi-candle retracement that lasts a significant period of time. A retracement is a real hammer to an option. Again, so is consolidation if it lasts for a long time, but the retracement is worse. Here we're taking the trade out of consolidation or out of retracement when multi-time frames align and money is flowing into the financial instrument we're looking at. And these almost always correlate. Again, like I said, you don't get order from disorder without the application of money. And this is telling you that all your correlative markets are moving in the appropriate direction. And this is telling you that you have multi-time frame alignment, your 2 higher time frames. All resistance to the upside is broken. and you are in the trade, and off you go. Now, I think I'm just going to move over. Now, let me move over to the charts, because the proof is in the pudding, and, you know, I can show you these till I'm blue in the face, but it doesn't make much of a difference. Now, let's go back a few days, because this has been a horrible market. Now, I'm showing you crude oil because it's got a lot of volatility. I could show you the E-mini. And for all intents and purposes, I could block out the instrument. It doesn't matter. This could be Google. This could be Facebook. This could be any stock. It makes absolutely no difference. The only variable that changes is your goal. If you day trade stocks or options, your time frame is short. If you swing trade stocks or options, your time frame is going to be longer. It's going to be intermediate. And the time frame that you're going to choose is going to be based on the average true range of the stock. And we can tell you the optimal time frame to trade. We've analyzed and have booked an enormous number of stocks. If you want to trade penny stocks and really small stocks, we'll have to do the analysis for you. But here's a transition zone trade right here. We look for the time frame alignment. Now we have this on an algorithmic system. So with the trade is automatic, and it triggered today, and I'll show you the trade. And a black line crosses right through the candle, telling you that the algorithmic system is on and assessing the trade. And what the algorithmic system is looking for is your first retracement right here. Now, it's got to come within 5 candles of the zone. You want to take a trade early in the beginning of a multi-time frame move to the downside. And that's all in the automated algorithmic system, which again can be active on any instrument. You're going to be in here, and you're going to go all the way to here. Now, I didn't make this trade up. That's 74 ticks. Now, you're not going to really go that far, and I'll show you why. First of all, this doesn't stop you out, I don't think. See, this goes 14. It's a magic number for some reason that this instrument likes to retrace 14 and then roll over. That's why our stop is 15. What the system, though, is going to take you out on is this first down candle on a yellow modified 15 here. That tells you that the trend is likely to be over. It's all based on probability. Remember, nothing is perfect. So on the automated system, you're going to be out at 32. And you're going to get 7 ticks on your first contract. So this is a $390 trade. And this isn't made up. Now again, this could be 32 cents. It doesn't matter. This could be on a higher time frame. It could be a much bigger move, and you could capture the entire move on a higher time frame. It all depends on what you want to trade and the average true range of the instrument. Now here we have a transition zone, but we have no pullback. So we have no trade. Here we have a transition zone, but it's too far up. Remember, we want the retracement to occur in the first few candles, and we have another parameter, and I don't want to make it too complicated for you, but it's the space between the 50 and the 15. We would like it, and the algorithmic system is geared to try to get you less than 7 ticks or cents. But it will sometimes go to 15 to 20 if you're close to the 50. And the candle is tight to the modified 15. It'll give way. But this is a way overbought trade. You can't take it. Now here again, transition zone. Once you get a pullback, the zone's over. Now here is a zone. And this goes 3, and this is a rare loser. This is a full. Now the thing is, what we do is we exit on a reversal candle. So we're taking this trade short. The system is configured to close on this up candle. This is what limits your losses. So you're going to go and you're going to exit on the close of this up candle, and you're only going to lose 6 cents or 6 ticks. That's why your downside risk is so small. Instead of losing all the way to 10, which is your initial stop, you only lose 60% of that. On 2 contracts, that's $120. And here's your next transition zone trade, right here. There's the quick retracement. There's the zone. The system is going to draw a black line right through it, telling you it's engaged and looking for a pullback to resistance. Down you go. Now this one's going to come up, I think, more than 15. Comes up 20. So it's going to take you out with a modest profit. Not a big winner, but the key is it goes 22 in your favor. So it's going to come back 15 and stop you out. That gives you 7 and 7. That's a $140 trade. That's 14 ticks, 14 cents, 14 pips, however you want to analyze it. And this is simply a continuation short with the quant and background bias telling you that it's a good idea to take a roll to the downside. It's not a transition zone trade. It's just a system-generated continuation trade to the short side. And that's a 38-tick trade. Now here's a transition zone with no entry. The pullback is a multi-candle. And then you lose that first 5 candles. You just can't get into this trade. And I'm also looking at 3 o'clock in the morning, 2 o'clock in the morning. Now here is your transition zone entry. Your first retracement, well, I'm sorry, I'm wrong. I take that back. Here's your entry. First candle that retraces on the zone. Now, you're not going to make that much money, but the key is you're going to make money. And remember, you're trading at 4 o'clock in the morning here. You go 13, you lock in $20 of profit, and that's all you make. You get your commission, and you make enough for a McDonald's hamburger. On this transition, here it is again. The retracement and the creation of the zone. The most powerful entry possible. This tells you that your trading chart is moving back, but your higher time frames have continued to move to the upside against the trend of your trading chart. Now let's see. Now this comes back 20. So this is going to take you up 21. And you're going to make 7 and 7. You're going to make another $140. You just can't hang in the trade. But so far, we've only found one loser. And that's the key. Now this is 1, 2, 3, 4, 5, and your entry on a transition zone trade. It's the first pullback after the zone. Now, on the algorithm, this may or not be an entry. It's a 6th candle, but sometimes it'll give it to you. If it did, and I can't tell you in retrospect, you have a 103 tick trade or a $1.03 on whatever financial instrument you're trading. That's a lot of money. Remember, we found one loser that cost us 6 ticks or 6 cents, and we just made a trade that we made a $1.03 on, or we made 103 ticks. And actually, we didn't make 103 because it's going to come back 15. And actually, yep, it's going to come back because it's going to come back. That's the candle. That's the exit candle, and it's going to take us out at 15. So we're going to wind up making 88 ticks and 7. That's 95 ticks, 95 cents. There's a transition zone right here. Early retracement in the trend. Now I know this is tedious, but I just don't want to ask you to take a risk on this off a JPEG. I want you to look at a real chart and see how the trade behaves in a real market. This is what most people will not show you. It's all well and good to see a presentation and for you to be told how great it works. But then let's see how it works in a live market. And this is boring and it's tedious. But this is really the nuts and bolts. This is where the trade, the right edge of the trade, is the toughest place to be, I think, anyway. I've done a lot of things in my life, but this is one of the toughest places to be on the planet. It's on the right edge of a trade because you have to make a prediction and you have to base it on system analysis. Now, the nice thing about this trade is you're going to get a black line right through the candle. Doesn't matter whether it's a stock, Forex, a future, whatever. It means the algorithmic system is kicked in. It's going to analyze the trade, and it's going to put you in the trade. And it's just going to follow the ATM unless you intervene and take it out earlier. Now, I said we normally close the trade at upside resistance. We got it here. The algorithmic may have taken the trade out at just +4, which would have given us 7 and 4, $110. It's not bad for a 2-contract trade. The key is we don't find losers. And here's another trade. And I'm telling you, I could do this till I'm blue in the face. Here's the pullback on your trading chart telling you that price is retracing on the time frame that we're trading, but your 2 higher time frames are continuing to the upside. That is an enormously powerful signal. This one, now these are hard to spot sometimes, and you can take these trades up, it goes 22. And unless you take it out, actually it's going to go right to the high pivot. Pivot's going to take it out. You're going to go right to upside resistance. So you're going to get 12 and you get 7. That's $190 on futures. It's 19 ticks on futures, 19 cents on stocks. It's a good move on an options trade. If you're day trading an option and you see an entry here on a stock, the potential for an up move is almost, like I said, 85% or greater. And it's not going to be a small move. It's going to be a significant move. The bottom line is you don't sustain a loss And here is the trade again. It's the pullback, early pullback with the higher time frames kicked in for you. And this is a big trade. So far we've seen one loser for $120. Here's a 41 cent tick or pip trade. You're going to give back 15. There's no reason to take it out. And so you're going to wind up with 26. And you're going to wind up with 33 cents or ticks or pips. That's $300 on futures. Depending upon the Forex pair you're trading, it's 330 or more, 330 or less. On stocks, depending on the stock and how many shares you're trading, it's a nice move. See, here's a move through the zone with no retracement, no trade. You can't trade it because this is a rising 50. Remember, I said one of the criteria is the 50 must be down and the 15 must be down. And here it is again. I'm going to stop with this one because I'm telling you, I can show you these till I'm blue in the face. If you want a trading signal that's going to make you money, I have personally never seen one better than this. And it's not, and the key here is it isn't a black box system. Now, I forgot how much time I have. I don't want to get cut off. Hold on, let me just find out how much time I've got. Hold on one second. Okay, I've got time. Okay, so I still have time. I can show you these till I'm blue in the face. Here's a 32 cent, 32 tick, 32 pip move. Really, don't get beguiled or thrown off by the fact that this is crude. This can be any financial instrument, and this can be any time frame. All you have to care about is that your higher time frames are aligned to the downside, your correlative markets are moving down, and we have great quant lines for stocks. And I don't want to give you away our magic sauce here, but we have some of the assessment is the VIX. Some of the assessment is up, down, volume. Some of the assessment is sector strength. That's why we have different quant lines for different stocks. We have to determine a sector, and there's other stuff. This is just some of it. We want the sector to be showing strength. We want up-down volume to be in our direction. We want the VIX to be moving in the appropriate direction. These highly correlate with the direction of the trade. Now, I just want to say one more thing that's extremely important, and I'm going to do it here. A lot of day traders want to trade with sensitivity. Now, sensitivity, and this is going to be boring again, is true positives. But if you don't understand this, I'm telling you, you can't day trade. And I don't care what it is, options, stocks, and you can't swing trade either. It's true positives over true positives plus false positives. Now, if you trade with a huge degree of sensitivity, you want to get into every true positive move, Every time the market makes a move to the upside, you want to be on that trade and go long. Every time it makes a move to the down. Now, I'm being a little hyperbolic here because you're not going to try to get but you're going to try to get in on every move that has the potential to get you a first target. The price is you're going to get a lot of false positive trades or losers. And that's the problem with a lot of day trading with your mindset. What you have to be available to do is let some winners go because they don't meet your entry criteria. And that's trading with specificity. And day traders that trade with specificity make money. What you want to know are what are the true negatives. Those are the losers. That's being specific. Only taking trades where you make the market come to you. Because that's true negatives plus false negatives. And a false negative is when you decide that the trade is not going to go, but it does go. It isn't a negative, it's a winner. But you should not care, cry, lament, or walk around, having a problem with it. If you're going to try to get in on every trade that wins, you're going to get murdered. Now, the key number is positive predictive value. And if you understand this, I'm telling you, it's going to change your thought process. Now, what I always do, and I attend a lot of webinars, and the only question I ever ask someone is what is the sensitivity, what is the specificity, and what is the predictive value of your trading entry, whether it's an option, whether it's a stock, whether it's a future, or whether it's a Forex. And if they don't know that number, then they don't know anything about their trading methodology. So positive predictive value is sensitivity over specificity, and it's times a very, very key number, and that is prevalence. Now, this is why I want you to understand these numbers. Now, sensitivity and specificity are fixed variables depending on your trading parameters. Here's an independent variable that varies. Prevalence, what is the likelihood of getting a winning trade? When does the market move or follow through? The prevalence of a winning trade occurs when there is a defined trend. That's where the prevalence is high. So if you trade a choppy market or your software does not define chop, irrespective of the sensitivity and specificity of your trading entry, prevalence goes to heck. And when you multiply these times prevalence, you wind up with a positive predictive value that's lousy. And maybe it's 30% or 40% of your trades are winners. And that's never going to make you profitable. So you can only trade in a defined trend where the prevalence of a winner is high or the trend is high. And you want to trade with a high degree of specificity. Make the market come to you. That's why this trade configuration is so powerful. You can take it on a discretionary basis, or you can let our automated system take it for you. Either one is going to work for you. And here's another winner. The problem here, now this pivot may or may not have been here at the time of the trade, but here is your first move down, your retracement. If it was here, it wouldn't take the trade because there's no room. If it wasn't there yet, you would have gotten a 16-tick trade. Not much money. Here's the thing, though. Yeah, it would have given you 16. You would be out here because you can see on this up close, the modified 15 turns, no, it would have gone 15. It would have come back 15 on you. So you would have made 80 bucks, but you would have made money. That's the key. Here, there's no early retracement. Here's the zone. No early retracement. No early continuation trade. No trade. If it doesn't meet our criteria, we don't take it. And here's the beaut right here. Whoops, nope, the transition zone. Right here. Now it's 1, 2, 3, 4, 5, 6. I don't know if this would have been triggered. I'll let it go because it's 7 candles into the zone. So it's an iffy, and I don't want to show you a winner I'm not sure that the system would have got you into. Here, the downside pivot is going to stop any trade. This is just a precipitous fall with no retracement. And here's your trade. The move down, the move up. You can see, well, it's a yellow modified 15, no trade. This breaks the candle to the downside, no trade. Even though it's a winner, it's just no trade. Here, you're kind of tight to this pivot. Even if you took the trade, you made money right here. I don't know if it would have happened or not. You won 7, you lost 30 bucks on this trade. I'll show you one more. So if we found one loser and 130, here's the trade. Right here. Little far into the zone. It's 1, 2, 3, 4, 5. It's your 6th candle. The algorithmic system would take it. And I passed by a lot of winners that I did not think you'd get into. And here you go. 58 ticks, 58 cents, 58 pips. It's going to come back 15 if you don't take it out on your own, which you can always do. And when you're up 50 cents or 50 pips or 50 ticks, it's a great idea. I mean, you have to go 65 to make more money. Not that many trades do that. So if you just let the system go, you'd give up 15, you'd be up 43, 7 here, 50 cents on this trade. I mean, this takes those small losers you get, and we found one $30 loser and one $120 loser, and just destroys them. That's the risk to reward. Now remember, this is a system that can be leveraged on any financial instrument. Now let me just go to questions and take a look what's there. Okay, and I got a bunch of them here. And let me just get those done. Okay, great. Everyone's answering whether you can hear me or not. Oh, really nice. Okay, this is from early this morning. Okay, let me go. Okay. Bree, you know what? The only reason I can't show a stock trade is because I have to disconnect CQG. I have to reconnect our kinetic data feed. But you have to trust me that all these financial instruments move exactly the same. I mean, I could have blocked out the financial instrument. They all move identical. Once there's a multi-time frame alignment and money is flowing into your financial instrument early in the development of a multi-higher time frame move to the upside, your financial instrument, irrespective of what you're trading, is going to move up. I just picked futures because it's what we trade, and it would take me a little bit of time to format our stocks. We have a whole bunch. We have formatted. We have we don't have Google because it's too expensive, but we have Netflix, we have Facebook, we have Apple, and then I always like to take a less volatile New York Stock Exchange, non-NASDAQ stock, and for a while I traded Delta Airlines, and now we trade OAS, which is, I'm going to block on the, I'll tell you in a second what it is. It's leveraged highly to oil. It's very volatile, and we get big moves. It's only a $10 stock, and you can really make great money on it. And I'll tell you the name of the company in a second. I'm sorry. It's Oasis Petroleum, and we had a stock. We had a vertical spread on it last month. We made 100% of our net credit on that stock, on that vertical. Correct, Bree. It's much more than just looking at your trend lines, because what you're looking for is a multi-time frame alignment. What this is telling you is we're trading an 8 range. Say we're trading, we trade Apple on an 8 range. And what we know from looking at this chart is that the 15 on Apple's 13 range is going to the upside. The 15, this line, on Apple's 21 range is going to the upside. The 50 on Apple's 13 range is going to the upside. The 50 on Apple's 21 range is going to the upside. We also know that there is no upside resistance to stop the move on Apple till at least we hit a first target. If there is, the background will not go green. If there's a pivot, it won't give you a green background. So that's what it's telling you. So what's the likelihood that this trade isn't going to move to the upside? Once you get a retracement off support and a confirmation move to the upside, this candle, you're in one tick above the close, the likelihood of failure is extremely low. Now, obviously, it's not 100%. We found a loser. But we found 7, 8, 9, 10 winners, of which many were 40, 50 cents, ticks, pips, whatever you want. So it's much, much more sophisticated than that. Plus, we want money flow. We want to document that money is flowing into your stock. The sector is moving in the appropriate direction. Volume is moving in the appropriate direction. Volatility is moving in the appropriate direction. And other parameters that helps you get a winning trade. It creates a scenario where sometimes you're going to miss a winner, but remember, we're trading with specificity. When we get into a trade, we want to do everything we can to ensure that that trade is a winner. That's all that matters. If we don't get a setup and we miss an entry, it doesn't make any difference. The entries will come. The only important thing is our trading entry has the kind of predictive value we want to become profitable. This is the methodology that traders don't follow. They trade oscillators and just MACDs and just trend lines on their trading chart alone. They run into reversals. They run into consolidation. They run into retracements. If you're 2 higher time frames, I've just recently moved to the upside, and you're early up on a move, the likelihood of the follow through to the upside is very, very strong. That's the key. Sidestep the consolidation, sidestep the retracements because you take it out of a retracement, and sidestep the reversals. Now we caught one reversal, but that's what was 1 out of about 10 trades, and the loss was minuscule. This one winner alone was 3 or 4 times the one full loser and the $30 loser we found. That's your other thing. Your risk to reward is key. Because, Bree, we've optimized the system. And for intraday trading, the 15-day, this is a proprietary moving average. If you put the 15-period SMA and EMA over it, they're all going to crisscross. This is the optimal trend line we found with 2 years of backtesting. Stocks, Forex, and futures. You've been told the 8-period moving average may be better, but has it been proved to you mathematically that it's better? That's where you have to step aside and say, what has been told to you and what has been proven? If we found that the 8-period was better, we would change it. I mean, it's very simple. We want to create winning trades, and we're not wed to anything. But these were what we determined after a huge amount of forward testing over a 2-year period. HE, you're correct. That's why correlative markets do change. That's why these markets must have a correlation coefficient of 70% or greater. And there are some trades that will get away from you where the correlative markets don't signal a trade. They are imperfect. But what you're trying to do is create a scenario, and here's another winner, where your entry creates a winner. And you're absolutely correct. Ancillary and correlated markets often change over time. That happens. But these markets over the previous 2 years that we have in this line correlate with a 70% coefficient, 70% probability or greater. We will continue to test that. If the correlative markets stop, we'll take them out of the quant line. That's not an issue. And the issue is sometimes you get nice moves without quant verification. That's where you try to trade with sensitivity, not specificity, and you're going to wind up getting yourself knocked over the head. All you are interested in is confirming a trade with all the information you have. And this transition zone entry is the best single entry that I've seen. Well, payment, supply and demand is really nothing more than money flow. And that's what the correlative market is showing. The correlative markets are showing you a direct indication of where money is moving. And we don't look at the 60-minute or higher time frames because this indicator is doing it for us. I mean, if you trade a 15-minute, it's going to look at a 45-minute, and it's going to look at 3 times 45 minutes. If you trade a 10-minute, it's going to look at a 30-minute, and it's going to look at a 90-minute. We believe that the best assessment of your 2 higher time frames are 3 times your trading chart, and then 3 times greater than that, the 2 higher time frames. That's what we found gives you the best precision on an entry. If you take your higher time frames and make them longer, they take too long to turn. If you make them shorter, the trades become whippy and you get pulled into a trade that doesn't follow through. Those are the optimal time frames, and we found them based on a lot of mathematical testing. Nothing on the system is assumed. It's all been proven. And that's why there's no oscillator, MACD, fibs, or this, excuse me, but the nonsense that people trade that blow 95% of all of us over a cliff. And they continue to do it over and over again because they're taught the same methodology without modification.
Mark, hey, this is Dan. Sorry to interrupt. I just want to remind you that it's 12:09 and need you to wrap up here in a little bit.
Okay.
So I can stay on time.
I'll be out in 60 seconds, and I really appreciate it. Okay, volume is right here. You see this number in the lower right-hand corner? It's a really unique volume indicator. A lot of people will do volume by candles. We don't care about volume by candles. Volume by candle gives you two independent variables, and that is the rate of candle formation and the rate of trades. We don't care how quick the candles form. What we care is how many issues are crossing, how many futures are crossing per minute. So this number is super important. This gives you a tremendous handle on volume. Now I'll show you, I'm really running out of time. We do include the volume indicator, but I didn't want to put it in here just because I didn't want to get you confused, and I wanted you to focus on what's really important. But our volume indicator simply graphs out in bars contracts, shares, or lots per minute. And you're correct. Volume is a critical parameter. When volume is dead, you stop trading. It does, payment, automatically does. So listen, I'm going to go because I don't want to overstay my welcome, and everybody here has been very, very kind to me. Let me just show you, we have a special for this, and then so it's a last slide, and then I'm going to leave. It's right here. Normally, the transition zone software is $14.99. We're selling it for $798. It's yours for life. It comes with support. Everybody who buys the software will get a we'll do a 1 or 2 hour webinar, and I will go over everything you need, all the parameters to take really effective trades on the transition zone, and we will look at stocks. We will look at any financial instrument you want, and you will see they all trade the same. Any time frame trades the same, 4-hour bars, daily bars. It doesn't make any difference. $16.99 is for the automated entry. It's normally $3,400. When you get in, the system does it for you. You can't miss an entry. And you don't even have to be in front of your chart to trade it. It's all done automatically. If you want to trade stocks automatically, this is the way to do it. Now, the first everyone who purchases we'll get the webinar on how exactly the trades work. We'll go over all the parameters. And the first 5 who purchase get 6 months in our live trading room. And that's a futures trading room. So it may not be great for those of you that trade stocks. But you get 6 months of our NDT trade execution platform, which I did not show you, which is remarkably helpful in letting you trade stocks. It's a patent pending. You're going to get our weekly didactic sessions where I teach you how to trade. Whether it's stocks, futures, or forex, it doesn't matter. You're going to learn how to read price action and market structure, not just price action, but price action and market structure, how to see consolidation, how to see rising and falling channels into the trend. Very information you normally pay a lot of money for. You're just going to get it. And you also get, and this is only true of our first 5, all the new markets on the transition zones as they're added. And we're going to add the ES, the GC, and the NQ. We're already active on stocks. But as we go to more markets, you're going to get them all. And we'll leave this, I was going to change the day, but we'll leave it up all week. Today is Wednesday, I believe. It's good through Friday. So if you're interested, we're going to send you an email with the purchase link. or give us a call. We'll be happy to answer any questions. So listen, everyone, have a really wonderful afternoon. I don't want to push anyone further out. Hold on one sec. Here we are at RightLineTrading.com or info@RightLineTrading.com, and our phone number is 855-765-6681. Go to the website. Our phone number's there. And I hope it doesn't matter what you do, whether you buy our software, you don't. I honest to God wish you all the best of luck, and hope all of you are really profitable and make money and make this a really great career for yourselves. So take care and have a great afternoon. So long.